After absolutely brutal last week, today we see a rebound. But not all the stocks are rebounding. We can see semiconductor sector are all in a red. Semiconductor equipment, red. Computer hardware, red. Communication equipment, red. Also, some industrial companies are red, but we can also see some green islands in this map. Financials are green, utilities are green, even communication services are green. Meanwhile, in the year-to-date performance, we can see technology, consumer cyclical, semiconductors, communication services, financials, all obliterated in this market. The only what is green is energy, utilities. Fear and greed index is 9, extreme fear. VIX is 30.45 in the last 5 years. VIX was north of 30 only 5 times in 5 years. VIX more than 30 is usually means the buying opportunity for long-term investors for high-quality companies. Meanwhile, the S&P is just 7.55% down year to date. So the question investors are asking why S&P is down only 8%. Meanwhile, we are extreme fear. Meanwhile, VIX is north of 30%. And all the tech stocks are already obliterated in this market. Is because S&P is the largest 500 companies in United States of America, and they include companies from different sectors. So here you can see the year-to-date performance for different sectors of S&P 500. And what we can see is the first, energy is plus 37% year-to-date. So just because S&P is well balanced with the companies from energy sector, basic materials, utilities, which are performing really well this year-to-date. Meanwhile, consumer cyclical, communication services, technology, financial, and healthcare are absolutely obliterated in this market. So we can say that what was happening these 3 months is a rotation from the tech, financials, communication services, and consumer cyclicals into utilities, basic materials, and energy. Now the question, is this rotation over, and now will our tech stocks will become beloved again? This is the question of the video we're going to answer. In this video, we're going to be reviewing 3 stocks and the reason why they are absolutely collapsing in this market. Is this a generational buying opportunity or we should stay away? The first company we're going to review is Microsoft. Microsoft declined 34% from all-time highs, and this decline is almost similar with the 23 bear market. The main reason of decline in Microsoft is, of course, this is the largest position in the ETF IGV, technology sector ETF, and Microsoft is the largest position there. So with the whole sector is declining, the Microsoft will take a hit as well. Why IGV has been collapsing is because Claude keep introducing new innovations and new features, and he's absolutely dominating enterprise segment. Meanwhile, Microsoft has productivity and business processes bringing $34 billion per quarter in revenue for Microsoft. So now the question is, if Claude is going to disrupt part of that revenue, part of that software revenue for Microsoft, this is why all software stocks was declining, is because Wall Street is trying to evaluate this risk and exit software company before the decline in revenue materializes. I built InvestKit to be able to very fast look at the company's financial and basically in 1 or 2 minutes already understand if this is a high quality company or not. So now let's use InvestKit to understand if we can see already some signs in Microsoft of the declines from the perspective of revenue up to the right, net income up to the right, free cash flow up to the right, margins, gross margin, I do not see any decline. The only decline I can see is in free cash flow margin, and the reason of this decline is because Microsoft is investing a lot in the capex. Going forward, free cash flow and stock-based compensation, free cash flow is growing from 2017 of $31 billion and now north of $70 billion. Meanwhile, the stock-based compensation did not increase as much as free cash flow. Very nice to see. Microsoft is very shareholder-friendly company. The free cash flow they are distributing through share buybacks and also dividends. Really nice for shareholders. Meanwhile, the debt has been growing in the last 2 years, but cash is also staying strong with $90 billion in total cash and cash equivalents. All per share metrics are growing, EPS, free cash flow per share, revenue per share, all growing up to the right. From the perspective of valuation, if we just zoom in, we can see that price to earnings, Microsoft is now trading at 22.6. Meanwhile, 10 years medium is 33.1. Now let's have a look at price to operating cash flow because, as I mentioned, Microsoft is investing into capex. And here the picture is even better. Microsoft is almost cheapest it's ever been in the last 10 years. Another thing I noticed while I was researching Microsoft is because we had a insider transaction. Here we have a director buying 5,000 shares at $400 per share. Now you can buy Microsoft with 350, lower than 350. So now we are getting better deal than this director was buying the shares in the open market. So we have the quite rare insider transactions in Microsoft. Now, I believe Microsoft is a strong company and has a huge moat, will not be so easily disrupted by AI. Meanwhile, Microsoft has intelligent cloud with $33 billion per quarter. So in this case, Microsoft has hardware, has software, and Microsoft has all the cards because they are very close to OpenAI. I do not think they will be so easily disrupted, but some part of enterprise clients could be leaving if they want to embrace the new technologies provided by cloud. So I believe that some correction is deserved, but 34% from all-time high for Microsoft probably is not well deserved. Coming to the second company, and this is Mercado Libre. Mercado Libre is down 38% from all-time highs. And the reason why investors are punishing Mercado Libre is because Mercado Libre was investing too much to take market share or support their dominance in Latin America. Even though the stock is down 40% from all-time highs, Mercado Libre will invest $11 billion in Brazil in 2026, 50% year over year, mainly in logistics, e-commerce, and fintech. Mercado Libre management sees significant opportunity in the Latin America, and they want to grow both commerce and fintech business. So they keep investing more into the business to make sure that the rivals like Amazon, also Chinese rivals, will not be able to disrupt their dominance in Latin America. Now let's use InvestKit to understand Mercado Libre's financials. In 2017, the revenue was $122 billion. Fast forward to 2025, $28.89 billion. This is absolutely the most beautiful chart in my life. Net income also growing, free cash flow growing, even though I have to say that free cash flow is inflated by their fintech business. So actually, free cash flow should be ignored in this particular case for Mercado Libre. Gross margin is stable, operating margin improving, net income margin improving, and free cash flow margin we should ignore as for now. From the perspective of valuation, if we see at price to earnings, right now Mercado Libre is trading at 40.91. Let's move here so that we will not be able to see this huge spike. And now we can see from September 21, the valuation is absolutely all-time low, 40%. Meanwhile, the company is still growing on the revenue side, 30%. Price to operating cash flow is the best metric to value Mercado Libre. And now price to operating cash flow is 7.24, absolutely dirt cheap for the company with such high quality management, which are all in on execution. The third company in the list is Amazon. Amazon down the list 22% from all-time highs. The main bear case for Amazon is because the oil is increasing the price significantly, and for Amazon, logistics is very key. So with high oil prices, the Amazon's margin will be shrink. But meanwhile, Amazon is not just e-commerce company. They also have third-party seller services, which is subscription, AWS, which is high margin cloud computing business. They have subscription services, including Amazon Prime, Audible, and other subscriptions, and also they have advertising services. Having said that, I believe that this is the great example how the company is declined, not because the particular reason of the company is doing something wrong, but because of the macroeconomic event. And in this case, long-term investors should be accumulating cheaper shares to take advantage when the market rebounds, and this company will grow back to the fair value. AWS is reaccelerating for 3 quarters in a row. Q2 2025, Q3 25, and Q4 25, AWS continue to reaccelerate, and with the innovation of cloud and the demand for cloud, I'm 100% sure in the next quarter we will see 26 or even 27% growth for AWS, which will be absolutely mind-blowing. Meanwhile, let me remind you that Amazon actually owns 14 to 16% of Anthropic. Financials of Amazon is as good as it gets. Revenue is growing, income is growing, free cash flow is damaged by high capex. All margins going up except of free cash flow margin because of capex as well. From the valuation perspective, Amazon right now is very, very cheap. I believe Amazon is a great opportunity as for now. The price to earnings is 27. The price to operating cash flow, which is the best metric to value the company, which is investing heavily into capex, less than 16. This is absolute low, 10 years low. Concluding my thoughts here, I believe Amazon and Mercado Libre are two companies which was punished without specific company reason based on the macroeconomic instability. This is the greatest opportunity for long-term investors to accumulate strong moat companies while they are selling off based on the macroeconomic environment. Meanwhile, for Microsoft, I can make a case that they will be losing some enterprise software market share because of the cloud disruption and dominating enterprise software. If you want to analyze the companies as fast as we did in this video and see all the beautiful charts, I will leave link to InvestKit in the description below, and all premium features are available for free. Feel free to come and give your feedback. Thank you so much for watching, and I will see you in the next one.